VOO is one of the most popular ETFs in the world, and for good reason. It gives you exposure to the top 500 companies in the US stock market at a low cost. And whether you're investing for growth, income, tech exposure, or whatever the case is, there's likely a version of the S&P 500 that's made for that exact goal. And in this video, I'll be covering 7 of the best ETFs that are built from the same companies in the S&P 500. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. First on the list is VOOG, the Vanguard S&P 500 Growth ETF. This fund tracks the S&P 500 Growth Index, and it invests in stocks with solid growth characteristics that are based on revenue growth, earnings growth, and price momentum. So rather than owning the entire S&P 500, VOOG only focuses on the growth side of it. For the portfolio of VOOG, this ETF has around 146 stocks, with top holdings in Nvidia, Microsoft, Apple, Google, Broadcom, and more that make up around 60% of the portfolio. And the sectors it's mostly exposed to are technology, which is about half, communications, and consumer discretionary. So this fund tilts much more into tech from its heavy weight in its top holdings, and since that's where a good chunk of the bigger growth stocks are. Getting to the fees, VOOG has an expense ratio of 0.07%, costing you $7 for every $10,000 invested. And while the broader stock market has been doing well, VOOG has been doing even better, with 5-year annual returns of around 14.4%, and 10-year annual returns of about 18%. And this is a few percent higher than the S&P 500, which is really solid. The S&P 500 is already a great fund, and the biggest advantage to VOOG is that it's giving you exposure to the best growth stocks out of that basket. So you'll be holding the stocks that are leading in innovation, technology, and the expansion of AI. And what that means for you is that these growth stocks are going to give you much higher potential returns than the overall market. And more risk comes with more reward. This fund leans heavy into the technology sector, and the top stocks make up a big portion of the portfolio. And that means if the tech sector takes a hit, or even if one or some of the big names go down, this fund is going to feel it. And since growth stocks in general come with more volatility, this ETF can have larger price movements to the upside and downside. But VOOG gives you focused exposure to the growth side of the S&P 500 with a low fee. And if you're an investor that believes growth stocks are going to be a big driver in the market, and you're okay with more risk for more growth potential, then this is definitely a fund to look into. Coming up in second, we have SPMO, the Invesco S&P 500 Momentum ETF. This fund tracks the S&P 500 Momentum Index, which invests in stocks in the S&P 500 that have a high momentum score. This score is calculated by measuring the stock's price movements over the last 12 months, not counting the most recent month, and also it adjusts for volatility. There's a few other filters, and the 100 stocks with the highest scores are picked for the portfolio. And then last, depending on which value is lower, the stocks will either have a weighted cap of 9% of the index or 3 times its market cap. From there, the index is reconstituted and rebalanced twice a year. Jumping to the portfolio, SPMO currently has 100 holdings in its portfolio, with the top holdings in names like Micron, Nvidia, Broadcom, Johnson & Johnson, AMD, and Google. And the top sectors it's exposed to are technology, which is about half, then industrials and communication. The momentum is leading more into technology with industrials behind because of the rapid expansion of AI and AI infrastructure. So right now, a large part of this fund is exposed to semiconductor companies, but remember, these holdings will change every 6 months. For the fees, SPMO has an expense ratio of 0.13%, costing you $13 for every 10K invested. And the returns for SPMO have been very solid, with 5-year annual returns of 23.5%, and annual returns of 20.5% over the last 10 years, which is pretty amazing. SPMO has had some serious growth over these past few years, and it's been doing its job to really capture the momentum and the growth in the stocks that have been leading this bull market. And during these expansion cycles in the market is where a momentum fund like SPMO can really shine by rotating in and out the best performers of the S&P 500 throughout the year. But it's important to keep in mind that this fund can underperform when the market shifts. If we face a correction, downturn, or recession, this fund is going to go down as well. It'll also underperform if market growth is more broad and spread across many names rather than being more concentrated. And since the holdings are only adjusted twice a year, SPMO could lag the trends and the upswings in the market. SPMO has some decent diversification, and it can match the returns of some of the best ETFs in the market. And if you want to invest in a fund that gives you exposure to the stocks with momentum and growth that are driving the market, then this is a fund to definitely put on your list. Now, shifting gears, our next fund is going to be VOOV, the Vanguard S&P 500 Value ETF. This fund tracks the S&P 500 Value Index. Unlike voog that picks stocks with growth characteristics, VOOV approaches it differently. It considers companies that looks cheap compared to what they earn, their valuations, and what they're bringing in. And it looks at three value factors, which are book value to price ratio, earnings to price, and sales to price. The stocks that get scored the highest make it into the value index, and the ones that fall in between value and growth could get partial weight in both types of indexes. This leaves the fund with a portfolio of 440 holdings in total, with its top holdings in Apple, Amazon, Exxon, Walmart, Costco, and others that make up less than a quarter of the portfolio. And the top sectors are technology, financials, healthcare, and industrials. The top holdings are pretty nicely spread along with the sectors, which makes for a much more balanced portfolio. And if you're wondering why names like Apple and Amazon are here, these are giant companies with strong financials that float between that value and growth line. And like other Vanguard funds, the fees are low, with an expense ratio of 0.07%, costing you $7 for every $10,000 invested. Sliding to the performance, this fund has had 5-year returns of 11.1% annually, and then annual returns of about 11.8% over the past decade, which is hard to complain about. Unlike the growth funds, VOOV is more about the well-established and financially solid companies that can also weather a storm. Since this fund is value-focused, it's going to be more defensive in nature and provide more stability and less volatility than the overall market or the S&P 500. With that being said, over the last few years, this fund has not only been outperformed by growth, but also the S&P 500. And that's just because many of the growth and tech stocks have been driving up the market over this period. And since this fund is kind of exposed away from that, it's not going to see all the benefits. But for those investors that want a diversified portfolio of stocks and exposure to the value side of the S&P 500 with more stability and less tech exposure, then this is a fund to keep in mind. Up at number 4, we have XLK, the Technology Select Sector SPDR ETF. This fund tracks the Technology Select Sector Index, which takes all the technology companies from the S&P 500 and puts it into one basket. So this index covers semiconductors, software, hardware, IT services, communication equipment, and more. Simply put, the GICS classifications is what decides what qualifies as a technology stock, and if that's the case and it's in the S&P 500, then it'll be in the fund. Jumping to the portfolio of XLK, this fund has only 74 holdings, with companies like Nvidia, Apple, Microsoft, AMD, Micron, and others, which make up about 60% of the fund, which makes it pretty top heavy. And since this is a tech fund, it's 100% exposed to the sector, but the industries that mostly make it up are semiconductors, software, and tech hardware and storage. The expense ratio of XLK is nice and low at 0.08%, costing you $8 for every $10,000 invested. And I mentioned earlier how much tech has been driving the market, and you can easily see that through this fund. XLK has 5-year annual returns of 21.2% and annual returns of nearly 25.5% in the last 10 years, making it one of the best performing funds on the list. With tech driving the market up, there's no surprise why this fund has had some amazing growth, and it still looks to have some great potential. This type of fund is the best way to get 100% exposure to technology without any non-tech funds diluting the growth. And as we're in the early stages of AI, there looks to be a lot of steam left in the tank for the future. Now, this high concentration is a double-edged sword. The top 3 stocks make up about a third of the fund, and there's only around 70 stocks with no diversification beyond tech. So if tech decides to flip, so will this fund, and there won't be much to cushion the fall. This is the trade-off, and it highlights the importance of having this as a complementary fund to a broader ETF. But those investors who believe the tech sector still has a lot of potential in the tank, and they're okay with the volatility that this fund comes with, then this is a solid tech fund to consider. Moving on to number 5, we have SPY, the Spider Portfolio S&P 500 High Dividend ETF. This fund tracks the S&P 500 High Dividend Index, which is made up of 80 high-yield companies within the S&P 500. And the index is pretty straightforward, as it chooses stocks that have an indicated or forward dividend yield that's greater than zero, and then it filters the top-ranked stocks by yield. And unlike other ETFs on this list, this index is equally weighted, so regardless how big a company is, the allocations are about the same. Pulling up the portfolio, SPY has about 78 holdings, and those top holdings are in Franklin Resources, Iron Mountain, CVS, Target, Simon Property, and more, which you can see the equal weight of the fund, so no company makes up a large chunk of the portfolio. On the sector side, real estate is up top, then consumer staples, financials, and utilities, which looks much different than the other funds so far, especially with the real estate exposure due to the filtering for the high yield stocks. And this is another low fee fund with an expense ratio of only 0.7%. And since this is a dividend fund, I have to mention the dividend yield, which is 4.19%, which is going to be paid out every single quarter. Now, for the returns, SPY has had annual returns of 8.2% in the last 5 years and annual returns of 8.5% over the past decade. Not as impressive as the growth funds, but let's remember the purpose of this fund. The strength of this fund comes from the dividend income that it provides and the more stable and lower volatile stocks that it holds. And this ETF has managed to have a dividend yield of around 4 to 5% historically, which is very solid. So not only do you have dividend income, but also well-established dividend-paying companies from the S&P 500 that tend to be more resilient. The obvious downside to this fund is the underperformance that it's had compared to the S&P 500 over the last decade. Also, since the filtering focuses on high yield, it causes the fund to lean more into real estate and other stocks that are more interest rate sensitive with less growth potential. But for those investors that want a high-paying traditional dividend ETF that leans into REITs and it has a balanced approach with its holdings, then this is a fund to look into. This next one is very different, and that's SPYi, the NEOS S&P 500 High Income ETF. Unlike the other ETFs, this one is actively managed, so the portfolio managers are in charge here. And the goal of this fund is to generate high monthly income with a call option strategy and provide you with exposure to the S&P 500 index. So SPY holds individual stocks from the S&P 500 and it sells out of the money call options on the S&P 500 to generate that high monthly income. And index options come with tax benefits since they're classified as Section 1256 contracts from the IRS, so they receive 60% long-term and 40% short-term capital gains tax. Getting to the portfolio of SPYi, this fund has 511 holdings, with top holdings in companies like Nvidia, Apple, Microsoft, Amazon, Meta, and others. And the sector exposure leaning mostly into technology, then financials and communication. This is very similar to what you'd find in a typical S&P 500 ETF when it comes to the holdings and the sectors. For the fees, SPYi has an expense ratio of 0.68%, costing you $68 for every 10K invested. Keep in mind it's going to be higher because it's an actively managed fund and they're working to generate that high monthly income for you. Which leads me to the dividends, where this fund has a dividend yield of nearly 12% that's paid out to you every single month. This is much higher than anything that you'd find with traditional dividend ETFs. Since SPYi was created in August 2022, it doesn't have a long history, but in the last 3 years, it's had total returns including dividends of about 15.4% and annual returns of about 15.3% since it was created about 4 years ago. What makes SPYi stand out is that sky-high dividend yield of 12% that's just so hard to compete with. Along with that income, you're still exposed to the stocks in the S&P 500, so you can still benefit from some possible appreciation as well. And to make it even better, the return of capital tax treatment that comes with this fund defers your taxes on that income until you sell the shares or until your cost basis reaches zero. But there's a big trade-off with this strategy. With covered call ETFs like SPYi, the call options limit the upside potential that you can participate in. So you're sacrificing capital appreciation for that monthly income. This is a big deal for someone still in the accumulation stage, since you don't need that income yet, and the growth can compound heavily over a long time period. SPYi is for those investors that are focused on generating income first over growing their portfolio size. And for those that want exposure to the S&P 500 with consistent double-digit monthly yields, then this is one to keep in mind. Coming to the tail end of the list, we have XLG, the Invesco S&P 500 Top 50 ETF. It does exactly what it says in the name, and it selects the top 50 largest companies by market cap from the S&P 500, which means it's pretty much going to be made up of the mega cap stocks in the S&P 500. And the fund is market cap weighted, so the biggest names are going to make up the largest portion of the fund, which currently XLG has 51 stocks in its portfolio. And the top holdings are Nvidia, Apple, Microsoft, Broadcom, Micron, and more, with the sector exposure leaning mostly on technology, then communication, consumer discretionary, and financials. And the makeup of this fund looks more like a growth fund since the mega cap tech names are making up a majority of the fund, which just works out this way since these are currently the largest companies in the market. For the fees, the expense ratio is 0.20%, costing you $20 for every 10K invested, which is a bit higher than some of the others, but it isn't too crazy. Because this fund leans into big companies, it's done well, with 5-year annual returns of 16.6% and annual returns of 17.4% over the last 10 years. This is pretty close to what you'd find with growth funds, which makes sense considering the mega cap growth names have been the main drivers of market growth over the past years, and the lineup of the top stocks are very similar. XLG is giving you exposure to the top 50 stocks at any given time in the market, with companies rolling in and out and market leaders changing over time. So while you're limited in holdings, you're diversified across the major companies, given that they're in different industries and sectors. But it's still very concentrated. 50 stocks with a portfolio that's top heavy means that it can be volatile, especially if those top stocks take a beating. Also, since this portfolio has a heavy tilt in technology, it's going to be pretty exposed to the news, sentiment, and movements of the sector. This doesn't take away from the fact that XLG is for those investors that want to own the top stocks of the US stock market. And if you're okay with the limited amount of holdings that it comes with for that exposure, then this could be an ETF for you. But if you care more about diversification and you want a simple way to maximize on it, I get into the best one ETF portfolio to buy and hold forever in this video here. Or if you're looking for some high growth ETFs, then check out this video here. And if you made it to the end, I really appreciate you watching, and don't forget to tap that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.